Hey guys, it's Asif at ThinkAsif.ca, and we have Michael Yosher from Integrity Mortgage Solutions. And the last time we spoke, we got into private mortgages. Today, we're going to look a little bit deeper into the perspective of becoming an investor. So, Mike, welcome back. Thank you for joining us. Tell me, who would be an investor for a private mortgage?
Well, typical profile of an investor for private mortgages is usually someone that's tired of the stock market, essentially. Back in '08, when you saw the big crash, a lot of people had their life savings, their retirement, fund, half of it, evaporated, right? So someone that's just tired of the crazy ups and downs of the market. It could also be someone who wants to have a tangible investment, something they could see, feel, and touch, right? And real estate really is that. It's simple to understand. It's lending on a house or a condo where you could drive to and see, there's my investment, right? It's not some, number on a piece of paper and some, unknown fund with some unknown manager you're trusting, in a bank behind a thick wall, right? And it's generally somebody who would not want to lock in their money for a long term. So somebody that wants, sort of in and out, a 1 year term or whatnot.
Can anybody be an investor?
Anybody can, not anybody should be an investor.
Okay.
Yeah. One of the things that you've seen with the market, kind of spiking up over the last 5-6 years is that you had a lot of people coming out of the woodworks and saying, hey, I'm a mortgage lender, I'd like to lend my monies. And no matter what they did, right or wrong, they were generally saved because the property values have skyrocketed. Right. So it didn't matter if you made poor decisions, you were kind of saved by the market.
Okay.
And now that we're going into a flat market, there have been some declines in some areas. It requires a higher level of expertise. And so when I say not everybody should, it's definitely something where once you get educated and you know the risks, I think it's a great investment. I invest personally, I invest my family's money. And I invest for my parents' retirement. Sometimes I think to myself, if I wasn't around, how the hell would these guys survive? Right? Thanks, Mom and Dad. I do appreciate everything you've done for me. I'm just sharing here.
Well, what are the risks involved with being an investor?
So I'll kind of give you a sort of high level risks first of all. First of all, greed is a huge risk. People focus too much on the return on their capital versus return of their capital, i.e. getting their money back. Sometimes people just see dollar signs dancing, in their heads and they think, I'm getting 12 or 13 or 15%, right? And people don't realize that there's a higher level of risk with a higher return. Just if you have a borrower that's willing to pay you 15%, you got to first ask why, if the market price is, 12, or 10 or whatnot. So there's certain levels of returns for certain levels of risk, right?
Okay.
So that's one huge risk. Another one is just not doing your homework.
Okay.
Lending in an area that may not be great, or not looking at the borrower's credit, for instance, and seeing someone who's a poor money manager. There's, for instance, it's a big difference between somebody, say, who maybe got sick, had a divorce, or had a certain period of their time in their life where they couldn't pay their bills for a certain time, versus somebody who you see on the record, is constantly late with Money Mart and payday loans and cell phone bills and small stuff like that. And you see it chronically throughout their history. That to me says this is a poor money manager, right? So I don't care how much you're going to pay me, and I don't care, how safe it is, how much equity there is. If you're a poor money manager, that's screaming for trouble.
Gotcha.
Right? So if you're someone that wants to get, tangled up in big legal messes, by all means, go ahead. But not my cup of tea. And I wouldn't recommend to anyone else to go into stuff like that.
Being an investor, what are the returns like?
Well, it really depends on the risk level of the loan. Is it a first mortgage or is it a second mortgage? And to what level have you lent on?
Explain that first mortgage, second mortgage thing.
Sure. So let's deal with a smaller situation where the loan would be a smaller dollar amount, is a second mortgage. And a second mortgage basically means that there is somebody in first position ahead of you. So typically somebody may have a mortgage with a bank, right? And so let's say a house is worth $1 million.
Okay.
Number simple. And they have a $500,000 mortgage with the bank.
Okay.
So they're at about 50%, right? And they come to you and they say, hey, I need $100,000.
Okay.
Right? So that would be a second mortgage.
Okay.
Right? A first mortgage would be as if someone comes to you and says, I want, 500,000 or 600,000, all in first position, meaning nobody is ahead of you.
Gotcha.
Right?
They don't have another mortgage in place.
That's right. There's no other mortgage in place. You are the bank.
Okay.
Yeah.
Okay. And what do those returns look like?
So a first mortgage returns can be anywhere between 7 to 8.5, sometimes as much as 9%. And a second mortgage can be anywhere from 10% to as high as 12, 13, 14%. Right? It really depends on the level of risk with the deal. Right? And really, what I mean by that is, so let's say that the house is worth $1 million, and let's say someone says, you know what, I want a loan for $300,000. Okay, well that's 30%, right? 300 on $1 million. I mean, there's much less risk there than if someone says, I want, $700,000.
Gotcha.
Right? Level of risk changes, therefore pricing changes as well.
Gotcha. So basically, the more money that's being lent out based on the value of the home, that is a higher risk level.
Correct.
So
Yeah.
as a result, my understanding is the higher the risk level, the higher the return.
Correct.
The lower the risk level, the lower the return.
Correct.
But it's safer from an investor standpoint.
Right. And I mean, we're covering a very sort of basic element. It's not just about, the equity in the home or the value of the home. There's other factors that, that go into play, like, the type of borrower, their income, their credit, and so on, right? But high level, yes, that is how we measure the return.
Location as well.
And location, of course.
Yeah.
I mean, if your house backs onto a railroad track, we're going to take that into, consideration, right? So.
Gotcha. Okay. And with regards to in the investors' returns, one of the things that may come up is, are there any additional costs that they may have to cover on their end?
For the investor, when they're lending out their money, no, there's no additional cost because the borrower usually pays for that. So the borrower pays for the investor's lawyer. The borrower pays for the appraisal cost. The only cost an investor may incur is should they need to enforce on the mortgage.
Okay.
And that's the unfortunate situation. If you've gone through a process and you've tried to deal with the borrower and the borrower can't pay or can't catch up and they're not willing to, to sell the house on their own or they're not willing to find a way to catch up for whatever reason, now you have to go to a lawyer and you have to do what's called a power of sale.
Okay.
Right? And at that point, depending on your relationship with your lawyer, you may have to be out of pocket a few $1,000s to get the lawyer to get that process going.
Gotcha. So it's important to understand that there are typically no real costs involved. There's a return, but you're taking on a risk. And the only real cost comes out of if things don't go well.
Correct.
Right? But up front, really, the borrower is the one who incurs all those costs.
Correct. And that's what I always say. It's always, they say, and how's that saying go? An ounce of prevention is worth a pound of cure or whatnot.
Yeah.
So the same thing goes when you're doing your homework on your underwriting, when you're reviewing the deal, right? The more patient you are and the more you go through, the methodology and, and I cover this like in our intro to private lending course, what to look out for and how to become, a private lender.
Gotcha. So with these new rule changes, have you seen an influx of investors on the market?
Absolutely, because there is a larger need for private funds in the market. With the banks tightening up their regulation, you've seen a lot of worthy borrowers that are, normally would get approved at, say, maybe not a bank, but say at a trust company or a B type of lender, now have to go to a private lending solution, right? So there's a greater need for private funds, and there's a great amount of people who want to lend their money out. So yeah, absolutely.
So I've often seen that for more of a senior investor, this is a better alternative to a GIC in terms of return on investment. Is that true?
So when you say, so it's definitely a better return.
Okay.
I mean, and it does carry a different level of risk.
Okay.
I mean, a private mortgage is not a GIC. I mean, a GIC, it's a guaranteed investment certificate.
Okay.
It means, you're putting your money in the bank, and unless, TD or Scotia or Royal or any of these banks, unless they go bankrupt, your money's still protected for the most part. Well, your first 100,000 is protected by CDIC.
CIC, yeah, okay.
Yeah. Private mortgage is not guaranteed. There is a certain level of risk to it. Now, there are lots of ways for you to lower your risk if you do the proper homework. If you look at the borrower's credit, if you look at the appraisal, the equity of the house, the situation, and most importantly, how are these people going to get out of the private mortgage? Meaning, what is your exit? How are you going to get your money back?
Gotcha. Okay.
So as a private lender, your first question should be to anybody that gives you a deal to look at is you got to ask yourself, not how much am I going to make or is this safe or not? Well, part of how is this safe is how am I going to get out? How are they going to pay me out? Are they going to go to a bank? Are they going to sell the property? What's the plan? Right?
How much of that underwriting do they do, or does someone else do the underwriting for that investor?
So it really depends on your own level of education, sophistication, and your willingness to want to do it.
Okay.
When I work with private investors, they've typically gone through, let's call it my intro to private lending, seminar, where I actually show them, this is what happens behind the curtain, right? I explain to them, this is how I lend, right? And I always tell them, look, I would put my money into this deal. You're more than welcome to ask me for money in this deal. This is why I think this is a good deal, right? But you got to do your own due diligence, right? So people should always do their own due diligence. They should always, review everything. After a while, you may get a comfort level with whoever you're working with and trust what they do. But I always say, beware, be careful, because you never know when something may go sideways.
Gotcha. Okay, fair enough. Well, again, thank you for joining us today. If you have any questions on becoming an investor, please contact Mike or contact myself. I'll put you in touch with Mike, and he'll be able to walk you through on, if you wanted to become an investor, what you need to know. So thanks again, Mike.
Thanks for having me.